Alex in the Brewhaven.
So, how are we going to identify the accounts that I will use for my business?
Easy. We need to review your business operation first.
Right. Can you tell me some examples?
Sure, I have some examples here.
Let's go to the conference room.
The assets accounts. Let's start with cash. Cash is pretty straightforward. It's the money a business has on hand, whether it's physical cash in the register or money in the bank. Think of it as the dollars and cents a company can readily spend to pay for goods, services, or expenses. Next is the accounts receivable, represents the money owed to a business by its customers for goods or services that have been delivered but not yet paid for. Your customer already received your goods but not yet paid, or services already rendered on account or credit. Rendered service means performed service, like a laundry shop rendering laundry for the client, or an accountant preparing reports for the business. On account means the purchase sale of goods or services on credit. Inventories refer to the goods a business holds to sell to customers. Think of it as the stuff a business has on hand to sell to make a profit. Office supplies are the materials and items a business uses to run its day-to-day operations. This could be anything from paper and pens to printer ink and staplers. They're the essentials that keep the office running smoothly. Prepaid expenses are payments made by a business in advance for goods or services that will be received in the future. For example, paying rent or insurance for several months in advance. It's like buying something now to use later. Here's a question for you. When the company paid cash for purchasing supplies, what are the two accounts that should be used? It is cash and supplies, paying cash and receiving supplies in return. Let us continue for non-current assets under the property, plant, and equipment accounts. Land represents the Earth's surface, including everything beneath it and above it. It's the solid ground upon which buildings, roads, and other structures are built. It is a long-term asset that businesses own and is not subject to depreciation. Next is buildings, which are structures erected on land, such as offices, factories, warehouses, or retail stores. They provide space for a company's operations. Buildings are tangible assets that are subject to depreciation over their useful lives. Machinery refers to equipment, tools, and machinery used in the production process. Machinery could include manufacturing equipment, vehicles, computers, and other specialized machinery necessary for business operations. Furniture includes items such as desks, chairs, tables, cabinets, and other fixtures used to furnish offices, workspaces, and other areas within a business. Next for non-current assets is the intangible assets, an asset that cannot be touched or seen. Instead, they represent rights or privileges that a company possesses. Such examples are: intellectual property refers to creations of the mind, such as patents, trademarks, copyrights, and trade secrets. These assets give a company exclusive rights to use or reproduce its inventions, brands, or creative works, and software is another common intangible asset. This includes computer programs, applications, and operating systems that are used to support business operations. Another question: when the company acquire land and buildings, what are the three accounts that should be included? It is the cash used to pay for the acquired land and building. Let's proceed to liabilities. First is the accounts payable, which represents the money a company owes to its suppliers or creditors for goods or services purchased on credit. When a company receives goods or services but hasn't yet paid for them, it records a liability in the form of accounts payable. Then, accrued expense refers to expenses that have been incurred but not yet paid for or recorded. These expenses are recognized in the accounting records when they are incurred, even if payment hasn't been made. Common examples of accrued expenses include accrued salaries and wages, accrued utilities, accrued interest, and accrued taxes. Next is bank loans. Payable represent the amount of money a company has borrowed from a bank or financial institution. When a company borrows funds, it creates a liability in the form of bank loans payable. This liability typically includes the principal amount borrowed as well as any accrued interest. Unearned income, also known as deferred revenue or advances from customers, refers to money received by a company in advance of providing goods or services. For current liabilities, we have mortgage payable is a liability account that represents the outstanding balance of a mortgage loan used to purchase real estate such as land, buildings, or other property. When a company borrows money from a lender to finance the purchase of real estate. Another common liability is the notes payable, which is a liability account that represents the amount of money a company owes to creditors or lenders through formal written agreements known as promissory notes. It can include short-term or long-term obligations, depending on the repayment terms specified in the promissory note. Here's a question for you. When the company borrows money from the bank in a short-term period, what are the two accounts that should be included? It is indeed the cash and bank loan payable, cash for borrowed money, and bank loans for liability. We'll be focusing on two main equity accounts, owner's capital and owner's drawing. Owner's capital represents the initial investment made by the owner of a business, plus any additional investments made over time. It reflects the total equity or ownership interest the owner have in the business. When a business is started, the owner contribute funds or assets to finance the operations, and this contribution is recorded as owner's capital. Fast question: when the owner invested cash in the business, what are the two accounts that should be included? Yes, the cash and the capital accounts. Next is the owner's drawing, also known as withdrawals or distributions, refers to the amounts withdrawn by the owners of a business for personal use. These withdrawals represent a reduction in the owner's equity in the business. When the owners take money out of the business for personal expenses, it's recorded as owner's drawing to track the decrease in the owner's capital. Question: when the owner withdrew cash from the business, what are the two accounts that should be included? Yes, the cash and drawings. Next is the revenue accounts. Service income represents the revenue earned by a business from providing services to its clients or customers. This could include services such as consulting, repairs, maintenance, or other professional services. When a company completes a service for a client and receives payment, it records the revenue earned from that service as service income. Professional income is similar to service income, but specifically refers to revenue earned by professionals such as lawyers, accountants, doctors, or architects for their expertise and services. Professional firms generate income by providing specialized services to clients, and this revenue is recorded as professional income. Sales represent the revenue earned by a business from selling goods or merchandise to its customers. This could include physical products such as electronics, clothing, groceries, or any other items sold by the business. When a company sells goods to customers and receives payment, it records the revenue earned from those sales as sales revenue. Here again, when the company received payment from service rendered, what are the two accounts that should be included? Right, the cash and service income. The final major account is the expense account. First, the salaries. It represents the compensation paid by a business to its employees for their work. This includes wages, salaries, bonuses, and any other forms of compensation. Second, the advertising expenses refer to the costs incurred by a business to promote its products or services to potential customers. This could include expenses related to print ads, online ads, television commercials, billboards, or other promotional activities. Third is the rent expenses, represent the payments made by a business to occupy or use property, facilities, or equipment owned by another party. This could include rent for office space, retail space, warehouses, or equipment leases. Fourth is license expenses. It referred to the fees paid by a business to obtain licenses or permits necessary to operate legally. This could include business licenses, professional licenses, or permits required by regulatory agencies. And last commonly used expenses is the utilities expenses, which represent the costs incurred by a business for essential services such as electricity, water, gas, heating, and cooling. These are necessary for the day-to-day operations of the business. Last question may be, when the company paid for its monthly rent, salaries of employees, water, and electricity, what are the 4 accounts that should be included? Yep, it is the cash as payment, salaries expense, rent and utilities expense. But remember that accounts are flexible depending on how you used it, and the purpose of having the accounts. It may be an asset for you, but liabilities for them. It may be expense for you, but revenue for them, or vice versa.
Got it, Tin. Wait, someone calling.
Don't you dare skip you quiz, Al!